So once again, you're welcome. And today is the third day of our master class. The first day we did a general introduction of forest. What is forest? What are the market participants, and why we should be interested in forest. Then in our last class, we looked at candlesticks. And we looked at candlesticks behaviors and patterns. How to actually use candlesticks in making decisions in the market. So today we are going to look at another very important technical aspect of trading, which is top-down analysis. We're going to look at top-down analysis. So, like our classes are usually very interactive. So we want to interact, because that way is a better way of learning. So when you hear the word top-down analysis, what comes to your mind? Yes, Favor. Your hand is up.
Okay. Yes, just like the name, top down. It's just like analyzing the market from a higher time frame down to the lower time frame. That is from the highest time frame, is the monthly time frame, down to the lowest you think possible, for depending on the kind of trader you are.
That's a perfect answer. That's a perfect answer. Top-down analysis is, like she said, you are looking at the market like from a higher time frame down to a lower time frame, and this is the best way to look at the market. Now, she also mentioned that it depends on the kind of trader that you are, which is true. Now, sometimes people give more attention to entry. People are more interested in entering the market than trying to understand what is actually happening in the market. You see, on a typical day, someone will just wake up and say, today I want to trade. Before you know, the person is on the 15 minutes time frame, or person could be in the 15 minutes time frame of 1 minute time frame. And there are even individuals who go as low as coming to the 1 minute time frame, and then they begin to look at the market and to place trades. So if that's the way you look at the market, then it will be very difficult for you to be consistently profitable, because trading is all about being consistently profitable, having more wins than losses. When you have more wins than losses, then you are a trader. Okay? So our goal is to be able to look at the market and make wise decisions. And to help us do that, that's why before we make decisions, we want to be able to look at the market with that top-down analysis view. We want to look at the market from a higher time frame down to a lower time frame. Because when we are talking about the market, we're talking about the largest financial market in the world. A $6.6 trillion a day market, the most liquid financial market. So what it means is that from the beginning of market opening by 10 p.m. yesterday down to 10 p.m. today, $6.6 trillion has exchanged hands in this market. So you can see that it is not a small market. So it's not something you just jump in and then you begin to pull out money. The market is very, very, very fierce. It's fierce. It's like the market is like a vampire. And what does vampire always look for? Vampire is always looking for blood. Always looking for blood. So the market is always looking for those individuals who do not know their left from their right, to suck them, to take whatever little money they have. That's what the market is after. So that is why when you are coming into the market, you want to come in with that sense of you want to come in with a kind of respect for the market. You don't just want to come in and straight away you come to your 5 minutes time frame or your 15 minutes time frame, and then you're shooting trades. So when you do that, then you become a victim. You become a victim consistently. So looking at the market from a higher time frame is like, because what we are basically doing when we say we are trading, we are like detectives. We are like detectives in the market. We are like those who are working in the force, detectives. That is what we are doing. We look at the market, and our goal is to pick out opportunities when there are opportunities in the market, and then we jump in. So for us to do a very good job as detectives, we need to be able to have an overall, we should be able to have an overall view of what is happening in the market. And for us to do that, we need to look at the market from the top, from the highest, get an overall view of what is happening. So when we are just looking at the market from the lower time frames, we will not really know what is happening on the higher time frame. I usually use this example of why we should be doing top-down analysis in the market. So it's just like when you are, because as detectives, imagine you are in charge of the security of the place you are currently living at now, and they said they put you in charge that you should be doing surveillance of that area. So when you're doing that surveillance, imagine you're doing that surveillance using just and you're either trekking using your foot, or using a motorcycle, or even a vehicle. Will you be able to actually know what is happening in the entire area? Will you? The answer is no, because some of the buildings are fenced. Well, imagine if as part of your job, you actually provided with a jet or a helicopter. So when you're using, you cannot compare somebody who is on the ground doing surveillance using vehicle or his foot to someone who is doing surveillance using a chopper. Because when someone that is using a chopper will have an entire view of what is happening in that area. He sees everything. He will be able to see everything that is happening. So that is why we always want to be looking at the market from that angle, looking at it from trying to get an entire view of what is happening. Okay, now, for example, let's say we wanted to frame an idea on the currency pair that we are looking at now. We want to know if we are going to buy or if we are going to sell. We are currently on the 15 minutes time frame. Now, because we are on this 15 minutes time frame, we can see that the market is coming down. But then, are we going to, because it is coming down, and at this point now, we just start popping sales. We start selling the market, and after all, it is coming down. That okay, because this place is support, this place is resistance, and then we start selling or we start buying. No, we want to even know why is it selling at this point. So for us to be able to frame an idea, to know what the market is doing, we need to look at it from that higher time frame. We need to use a chopper or an helicopter to view the entire market. So that will not give us the general idea of what the market is going to do, whether it is bullish or it is bearish. So the first okay. So the first place we're going to go to is the monthly time frame. So in this monthly time frame, we'll see that it takes one complete month for one of these candles to form. It takes one complete month for each of these candles to form. So for the remaining one day, for the remaining one market day that is remaining in the month of April, this is what this currency pair has done for the entire month of April. This was what they did the previous month. This is for the month of February. This was January, December. This is November, October, September, and this was August. Now, looking at it from the monthly, we can see that from the monthly time frame, that for the past close to 1 year now, 1, 2, 3, 4, 5, 6, 7, 8, 9 months, that this currency pair has been going up. That's the idea, because we we were able to come to the highest time frame. That's the idea that we've now gathered from this point here. And we also we noted that it was actually coming down before it started going off from the month of August, that it was selling off heavily. Is that not so? Is that right?
It's right, sir.
Okay. All right. Just wanted to make sure that you guys are not sleeping on me. Okay, so it was coming down. And with our understanding from what we discussed in our last class about the candlesticks and the pattern, we earlier said that the market moves impulse. So this was an impulse. So whatever is happening now, as long as we are within this range, the range formed by the high here and the low here, as long as price is still within this range, we are regarding this buy now as a pullback or a retracement. Not until maybe the market continues buying, and eventually maybe take out the highs. Maybe take out the highs here. But for now, we are looking at so as long as we are still within the range here, the range formed by this low and this high, we are regarding this as a retracement. But even at that, the point remains that the market is going up on a monthly basis for close to 9 complete months. The market has been going up. Okay, but then while it is going up, we'll still be considering how far is it going to go. Is it going to go as high as maybe taking out the high that was formed here, this previous high? We don't know. So okay, but then if we note here, we will see that there are previous highs here. So we can note that point. You can take note of it. So we are viewing the market from the higher time frame to the lower time frame, so that we can frame an idea. We can understand why the market is doing what it is doing. So I noted that in the monthly, while we've been going buying for close to 9 months, that there is an old high here. There is an old high here on the monthly. And of course, I've also noted the low here, the high here. So stepping down to the weekly. So this is the weekly now. The weekly, we also note that just like in the monthly, that we've had the market going up. We have more of more of green candles. Just on rare occasions did we have black candles. So if we count from the month of August down to the present month of April, that is about to end in few days, that the market has been going up. Market has been going up. So these two, we can also look at this the same way we saw that this was an impulse, and we are regarding this as a kind of, that is a retracement, and we are going to see it as retracement as long as this high here, the high formed here, and the low here has not been taken out. So, but the market has also been impulsive. The market has also been impulsive, one-sided, more of going up, and going up. So, but we know that this is not the way the market moves. When there is an impulsive move, we should have a pullback, even if there is tendency for the market to go higher for a continuation. That was what we discussed in our last class, that we should get a pullback. So we've not gotten a pullback for a very long time. For almost 9 months, the market has just been one-sided, making impulsive move one direction. So the fact that we have an impulse, and this impulse on the weekly, we're seeing it as a pullback, but then we also need a pullback from the weekly. But I noted this high here because of the way the market, when the market is moving, the market is always interested in these high points like this. The reason being that there are liquidity lying above those old highs and old lows. So there are money there. A lot of persons, there are some persons who, when the market started dropping, when they saw that drop and it made this little pullback, a lot of persons started selling at this point here, and they were in profit. They were right. They were jubilating. They made money. So most of them are still holding on to those their orders, believing that the market is going to go down more. So that's why, though from the weekly, from what we are seeing in the weekly, we are expecting that there should be a retracement, there should be a pullback. But we expect that before that pullback will happen, that the market needs to go above these old highs here. The market needs to go above these old highs. So we do not want to be in a hurry to begin to sell off the market in anticipation of this pullback. So it will be much better if the market goes above. If the market goes above these old highs, then we can start. It will completely give us signs that it is time to pull back. But for now, these levels here now, these levels are too clean. They are too clean, and they should be cleared before the market will produce the pullback that we are anticipating on the weekly. So this is an impulse swing formed, an impulse swing formed in the monthly. This one is in the monthly. That is the main that is the main trend of the market. The main trend is this cell that we are inside. We are inside this main cell. The reason why we are still inside this main cell in the monthly is because price hasn't taken out the low, neither has it taken out the high. But then in the weekly we are buying. We are buying in the weekly. But we still expect the weekly to make more highs, to take out the clean levels, the clean equal lows or equal highs that are formed by these old highs here. So we now need to, so in our weekly, we're expecting we're expecting a pullback or a reversal or a continuation. We're expecting a continuation of our original trend. A continuation of our original trend. Our original trend is this sell. We're expecting a continuation of that. So when this market, if this market eventually or has no tendency to continue going higher, when it starts making sales, we expect it to come as low as taking out the lows from there. That would take, so imagine how long it took for this to happen, because we are looking at a higher time frame, the weekly. Please, in case I forget, in about 6 minutes, this meeting is going to time out. So when it does, please just rejoin. I don't know if that's noted. Is it noted?
Yes, sir.
Okay. So in the yeah, in our weekly, we are buying. We're buying. We've gotten an impulse swing that we know that the market should now be preparing either to, even if, so there are two things we are anticipating from this weekly. Either we get a pullback or the market completely sells off as a continuation of our original our original trend. Or if the market, even if the market wants to continue going up to maybe attack the old high, to take out the high, to change the entire structure of the market, the fact remains that we've been having an impulsive swing. We have had an impulsive swing in the weekly. So we expect that the market should sell off, but we are not selling it off now because we have levels that are too clean that the market needs to come and clean out. So when that happens, so let's now step down to the daily and see what is happening there. So in the daily, we still notice that we still had this, just like in the weekly, we still have this impulse, very big move that the market have been making without any significant pullback. Because like I kept emphasizing in our last class that the market moves impulse, correction, continuation, impulse, pullback, continuation, the same thing. Impulse, pullback, or retracement, continuation. So based on that, it's obvious that the market wants to sell off. The market wants to sell, because even if we are focusing on, even if we're focusing on this alone, even if we're focusing on this alone in the daily, for 1, 2, 3, 4, 5, 6, 7. That's more than 1 week. The market has just been one direction. One direction. So if we are focusing on this now, we can see that we still need a pullback, even if the market wants to continue going up. We need the market to produce that pullback, because that's how price is delivered. Price is impulse, pullback, or correction, and then it gives you a continuation. So, but then we still but we still need this level here to be cleared. When I said clear, we need the market to take it out so that there will be no so we need the liquidity that is there to be cleared. So from our weekly, our daily, we are expecting a sell. We need to sell. Now let's step down to the 4-hour. The 4-hour. The 4-hour is giving signs that a sell-off is coming, because see again in the 4-hour. See again in the 4-hour. This is a complete that's another impulse swing that is forming in the 4-hour. So normally when we have when the market sells off or goes in one direction like this, we expect that there is going to be a pullback. There's going to be a pullback. A pullback before you get a continuation. So we might this we might just see a situation where the market will individuals who may not have noted these that may not have noted this, that there is liquidity here. May be in a hurry to want to participate in this sell. Okay, and they may end up, because there is liquidity there, and the market cannot just sell off and leave up those highs,